Good morning and welcome to the Killik & Co market update. This week, one of the major headlines is the fact that the UK is now officially in a recession. But perhaps it's not quite as bad as this headline would have us believe. Let's have a look at exactly what this means and some of the underlying data. So first of all, what is a recession? Well, it's defined as 2 consecutive quarters of falling GDP. And what is GDP? Well, GDP, or Gross Domestic Product, is the value of goods and services produced by a country in a specific period of time. Normally we measure GDP on a quarterly basis. We compare the GDP for one quarter to the previous quarter and we calculate the change. So let's have a look at UK GDP over the last few years since the beginning of 2015. As you can see, we've been plodding along at a fairly constant pace for most of this period of time, and generally we add about 0.5% to our GDP every quarter. But if you have a look at the previous 2 quarters, they look very negative indeed, particularly the second quarter, where we've lost over 20% of the value of our GDP. So on this graph, it looks very, very negative indeed. However, a couple of things to bear in mind that make the situation seem a little bit more positive. Firstly, this data is already out of date. It may have been published this week, but it relates only up to the end of June, so things have moved on pretty significantly since then. There's also the fact that this data includes April, May and June. And for April, we know that our economy was in lockdown, so it's not surprising that people couldn't go to work, they couldn't produce things, they couldn't offer services, they couldn't make money. So it's not surprising that our GDP number for this quarter doesn't look particularly great. If we look at the monthly data, however, rather than the quarterly data, the picture does look a little bit more positive. Obviously, April was a bad month, but there was a notable improvement in May as lockdown restrictions were eased, and then again in June. So we would very much hope that this will continue as lockdown restrictions are eased further. Now, the press has been saying that UK data in GDP terms is much worse than that data for other major economies. And yes, that is true. But if we bear in mind that the UK derives about 80% of its GDP from services, the UK doesn't really produce or manufacture many things. 80% of our GDP comes from services. I think that helps to clarify exactly why our data looks so bad for this particular period of time. Let's have a look at what is contained within the services sector. It's things like restaurants, hotels, tourism, leisure. All of these types of businesses were forced by the government to close during the month of April. They weren't making any money whatsoever, and that's why the data for this quarter looks particularly bad. But we would very much hope that as we move out of this quarter into the next quarter, the situation will become more positive and the GDP figures will improve. Now, GDP numbers around the world are fairly negative at the moment, but stock markets seem to be telling a very different story. Let's have a look over in the US at the S&P 500, which is one of the major American stock market indices. At the moment, the S&P 500 is flirting with a record high that it previously hit earlier in the year before the coronavirus took hold. The S&P 500 has been approaching this level all week. Now, it hasn't got there yet, but if it does, it will be the fastest ever recovery that the index has made from a 30% fall. So that really would be quite a momentous piece of data. So why are stock markets so high at the moment? Well, there are a number of possible reasons for this. Number 1, stock markets tend to be forward-looking. Investors don't buy stocks depending on what's happening right now. They buy them based on what they think will happen in the future. So the fact that markets are high could imply that investors are seeing better times ahead and that they do expect us to get through this coronavirus crisis. And for example, stock markets have reacted positively to the progress we've seen in vaccine trials over the last few weeks. So that's one reason why markets could be high at the moment. Number 2, low interest rates. At the moment, it's virtually impossible to earn a decent interest rate on cash at the moment. And this fact alone could be forcing investors out of cash and into the stock market, which will push up prices. So that's another reason potentially why stock markets could be high at the moment. And finally, number 3, quantitative easing and fears of inflation. Central banks all around the world have been pumping huge amounts of money into stock markets in order to support economies at this very difficult time. And theory tells us that raising the money supply can increase inflation in the long run. Now, holding your wealth in cash is not going to do much to protect you against inflation. So perhaps these inflation fears are one reason why more investors have been putting money into the stock market. So 3 different reasons there why stock markets could be high despite despite the fact that GDP data around the world is not looking very good right now. And finally this week, Apple is being sued by the makers of Fortnite, which is one of the most popular games in the world with over 350 million registered users. Apple is being sued relating to unfair practices within its App Store. At the moment, Apple charges a fee of up to 30% of any revenue made through the App Store. And Fortnite is one of the highest grossing games of all time, earning about $34 million per month through the App Store. And Apple takes 30% of this, so it's not surprising that the makers of the game are not particularly happy about it. Spotify is another company that has previously voiced concerns about practices within the App Store, and in fact Spotify has complained to European antitrust regulators. Over the past couple of years, there has been concern about a potential crackdown on monopolistic behaviours within the technology sector, and these concerns were particularly high when Elizabeth Warren was running for president. However, now that Joe Biden has selected Kamala Harris as his running mate, these concerns have subsided because she has historically had a very good relationship with the tech sector, and perhaps that's a reason why Apple shares are currently very close to a record high. Moving on to have a look at next week, we're coming to the end of earnings seasons now, but we have got results out from copper miner Antofagasta, Chinese tech giant Alibaba, and cosmetics giant Estee Lauder. That's it from us. Have a great weekend, and we'll see you next Friday.